Welcome to the Victor H Investing live stream. It is great to be with you at the end of June and as we get ready to start July. It's been a good year so far, positive returns, really good returns for the first 6 months. I'll take it. And I wanted to collect my thoughts on how the month of June has gone and try to form some expectations as we head into July and really the second half of 2024. And looks like I've already got, one question on the live stream. Great. I'm going to answer that question for you. Just give it a minute. Just a quick reminder that I'm an individual investor, just sharing my experience, sharing my thoughts. And it's really no financial advice at all. I don't recommend you buy, hold, sell, short, buy options on any of the stocks that I cover. I'm just providing my comments. I hope you find them interesting, but it is not financial advice. I'm also being sponsored by Moomoo, and they provide a really nice offer of 8.1% on cash, which is a nice return. Thinking of the great stock returns we've had year to date, I'm parking some cash, which I'll get to later, and I'm parking cash with Moomoo earning 8.1%. So it's really going to set me up to have a good second half. If you'd like more information on that offer, look at the details in the live stream and you can look at that information. So this past week and best of, appreciate you joining. Awesome. And then Chi Wong, thanks for joining. I'm going to get to your questions. Just bear with me. I wanted to kind of open up with a little bit of information around what we've seen, and I'll really get to your questions. And David, thanks for joining. Appreciate you guys joining. So this past week was an interesting week, and we had if we look at the month, we had a rise in the month. Let me make this a lot bigger. So we had a rise in the month considerably, but then we had a fall this past week. And we've had a couple of things going on. Some sectors are performing great. Needless to say, technology, right? That's been the sector to be in for the last 2 years. And in 2024, technology is really just taking such a big share of all the gains, which is great to be a technology investor, but that's going to come to an end at some point. And I'm going to analyze NVIDIA a little bit later, but I'm happy to analyze any other technology company you guys are interested in. I see that Tesla is being requested. I'll analyze Tesla. And really, we're seeing really a market where technology, it's getting a little bit late on some of these trades. As you hear semiconductor companies with their valuations, you're seeing those stocks begin to give up some of their gains, and it may persist. I expect that they would, just because they need to come down and revert to their mean being the mean PE ratios, the mean valuations. So I expect that some sectors like technology, they've had a fantastic ride, but I think they're going to give up some gains. And some sectors are being left behind. The one that I'll point out is energy. Energy, especially oil companies, they do really well when oil prices are above $65, $70 per barrel, and we're north of $80 per barrel. And there hasn't been a strong rally in energy, but I think that the energy companies, when you see them announce their earnings, they should be fairly strong, that they generated more revenues, more profit, more free cash, and will probably buy back a lot of shares. So I'm expecting that out of energy. And that's the story of this year is, some sectors are performing great, but how much longer can they continue to perform at those levels? And then some sectors have been left behind, and those might be a good opportunity to buy into. Now, there's always an opportunity, no matter what the market, to find some stocks that are undervalued and buy them at the right time and then watch them rise over time. It's also an opportunity. I believe the market's rather expensive, and especially in technology, especially in semiconductor. So I've begun short positions on NVIDIA. I've started a short position on Broadcom and a couple of others. And, so far, so good. I might be wrong on how, on the timing of when it's going to happen, when a correction is going to happen, especially in those sectors. But I think I'm going to be right over the long haul that, hey, you know what? Prices were too high for semiconductor companies and anybody who's participating in the AI hype. So I'll share that with you a little later. Happy to dive into it as deep as you like. But that's been really interesting to kind of take on this month, the month of June. And I really started shorting stocks principally because I am an investor in technology. I've been investing in technology for 30 plus years. And I've got a list of really big successes and I've got a list of failures. Okay. So I know semiconductor. I've made money from semiconductor for 30 plus years. I've lost money on semiconductor. For example, I lost money on Intel, but I made a lot of money on Broadcom. I made a lot of money on TSM. I made a lot of money on Qualcomm. So that's an area that I'll always be an investor in, but I recognize the market's just too expensive. So I'm being careful in that area not to leave too much of my capital in that sector or in industry, because I think it's gonna start to correct at some point. All right, so the S&P had a negative week. It's been a long time since we had a negative week, and that's part of my. I get nervous when nobody's nervous, right? Everybody's greedy right now, and we just keep going week after week of gains on the market. Well, that's making me nervous when we see that for the year, it's been a really nice year. We had a 5% pullback in the March timeframe. That was healthy. And but for the year, I mean, we're up 15% on the S&P. Half a year. If we go at this rate, we'll be up 30%. Awesome. But it's just not in the cards, in my opinion, because even in 2023, which is a phenomenal year, we had a pullback of over 10%. So I'm expecting a healthy pullback at some point in the next 6 months. And the NASDAQ's doing even better. If we look at the NASDAQ, it's up 20% year to date. So at that rate, it'll be up 40%. And again, it's just not natural for it to just keep rising. In 2023, it had a pullback of 11.6%. So we should see some pullback in NASDAQ as well as S&P. The indexes that have not participated a whole lot has been, smaller companies, small, mid-sized companies. They haven't done so great. Here's the Russell 2000 year to date, 1.73 positive. That's terrible compared to the S&P. So that hasn't kept up with like bond values. So is there going to be a bounce back in small mid caps? Potentially. I just have been waiting for a bounce back in small mid cap for 2 years, and it hasn't happened. So I'm kind of being careful not to buy too many small stocks right now, because they have to get some momentum before I could really start putting more capital into small, mid-sized cap companies. The last section is the older companies that pay dividends. Those are the Dow-based stocks. It's up 3.72%, and that has not kept up with the S&P. So Dow hasn't been performing all that great. Over the last couple of years, it's done okay. For 1 year, I mean, I'll take a 13% return on the Dow, because they tend to pay dividends and they're more stable than NASDAQ and technology companies. All right, cool. So that's where we're at. I think we're in an expensive market. I'm being careful to invest in sectors that I think are going to do well over the next 12 to 18 months. And I'm protecting my capital by going into cash at a greater extent. I started the year probably with a cash level about 5% of my portfolio. I'm up to 11%. And I want to have cash available if we do have a correction to buy companies that I really like having, and buy into companies that are just going to be discounted when the momentum goes down. So we'll see when that happens. All right, so let me catch up on some comments. Best of. So what are my expectations for July? I think July, the beginning of July may tell us the rest of the July. We ended June with some concerns. We had high flying stocks like NVIDIA go down in last week. We had Supermicro, which is another AI stock. The volatility is extreme, and I should show that a little later. But it was down 8% on Friday, but it was up like 6% on Thursday. It's just up, down, up, down. So that type of behavior to me shows a sign of fear. Some people are fearful and they're getting out quickly. For example, out of Supermicro, I know NVIDIA had a couple of good down days this past week of the stock going down 3-4% for the day. If that is continued first week of July, I think we're going to be in for a negative month. If we go back to the party and stocks begin to rise, I think it's going to go up. I've been expecting that we're going to have a market that comes down, but it keeps going up, and the market's going to do what the market's going to do. All right, next comment. Chi Wong, thanks for joining. I think it's the first time you've asked a question. I appreciate you joining. Can I talk about SoFi, MU, and Tesla? Happy to. So give me a few minutes and I will cover all three. MU, I think, is Micron, and I think they announced last week. So let's take a look at that one. Next comment. David, good to see you, man. Neil, one of the regulars. Great to see you, man. Thanks for joining. And best of, appreciate the support. Do I think oil is going up or down? I don't know. I know that it's been creeping up, and I just don't know if it's going to go up or down. I don't think there's something out there that could cause a big change. For example, if you have a war in the Middle East, oil usually just jumps up. If you have any kind of conflict in the Middle East, it jumps up. We don't have anything like that. Nor is there a big either a glut of oil in the market. I'm not seeing any big factor that's going to change oil prices. But if they keep creeping up, the oil company is going to make a lot of money. So we'll see where that goes. All right, let's get into some stocks and start analyzing some stocks. So first one we're going to hit, let's start with Tesla. So Tesla had a very good week. It had it was up 7% for the past week, and it's up 11% for the month. Year to date, it's down 20%. And it's been kind of getting back off the mat. I mean, it was down quite a bit. It was down in the, what date is that? April 22nd was its low point, and it's up 39% from that low point. So it was kind of an interesting pickup. But overall, I think Tesla is priced too high. And I think that, from a business perspective, and let me show you, like, this is a new graph that I'm going to begin using on my stocks, and you'll see it. Let me try to get this centered. And what I'm trying to do is I'm trying to show that the competitive moat of a company is really important. And when you look at a company like Tesla, are they the only company on earth making EVs? No. They're now just about every company is making an EV. So there's a lot of competition. Do they have something special about their EVs? Now, I would grant them that they have the best brand in electric vehicles. I don't doubt that. I agree with that. I think it's a cool company. I'm a fan. But there's no monopoly-like condition for Tesla. And what you're seeing here is you want a company to be in the upper top level of this chart here. And the reason for it is the most valuable companies like Microsoft, NVIDIA, these companies tend to be on the very upper chart. And the reason for it is they're kind of like monopolies. Like Microsoft just dominates the desktop applications, Office. NVIDIA, obviously, they have the best GPUs right now. Very monopoly-like. Eli Lilly is just doing great. They have a variety of drugs, and they have strong patents on them. They're doing great. Amazon, biggest e-commerce company. Is Tesla part of this grouping? No, it's not. Why? Because they have a lot of competitors. I mean, some competitors are pretty damn strong. For example, Toyota. Toyota is coming on strong with their EVs. And I mean, I can go down the list of competitors. So having said that, I think Tesla is being priced like it belongs with Microsoft, Lilly, Nvidia, Amazon. But if you look at these companies do not have 30 competitors in their markets, but Tesla does. Tesla belongs more in the medium desirability, meaning they have a competitive moat that is good. Their brand is very strong. People prefer to have a Tesla. They're first to market. They have advantages. Their product's better, but they should not be priced like one of the big premium companies. They should be priced more like the best EV car company in the market. That's fine. If you did that, you have to bring them closer to Toyota, Ford, Volkswagen. And if you do that, you see that their stock price is really too high. So that's one way to look at Tesla. There's another way to look at Tesla, and that's by looking at their fundamentals. Looking at, well, that's fine and dandy, but man, how much cash flow do they produce? And will they produce so much cash that I'm going to love this investment? And the answer is no. Here's Tesla's valuation that I have, and they produce okay cash flow. They don't produce as much cash as Ford, as an example. Ford produces more free cash. So when you look at their cash forecast, and this is the cash that I expect the company is going to produce, it gives me a valuation of 73 billion. They have pretty good cash on the balance sheet, take away debt. They're really worth about 100 billion if I look at their cash flow forecast that I've put together for them, but their market cap's way above that. So if you're way above a cash forecast that I have, then I have to say that you're highly overpriced, priced at a premium 82%. So I haven't wavered from that on Tesla. I've done 2 videos on Tesla on my channel. You can look at them. So looking at the last year, you can see that I had the same opinion on Tesla. And over the past year, you can see that the stock price has just been coming down. It's down 24%. I think a lot of investors are realizing that Tesla is a car company and it's not a technology company. They're trying to reinvent themselves and say, oh no, we're going to be an AI company. Well, that's fine. You're kind of late to the game. ChatGPT started doing their thing 10 years ago. And now they've gotten to market. Google started doing their AI 10 years ago, and they have a product to market. Meta, similar. So for Tesla to say we're going to be an AI company is more of a headline that they're going after, which worked, by the way, because people are like, oh yeah, they're going to be an AI company. Yeah, in about 5 to 10 years. But for now, they're a car company. So those are my comments on Tesla. So the other one you asked for was SoFi. And SoFi, I've commented on other live streams. I'm not a buyer of SoFi. I think there's other alternatives that I like more. And the reason for my pessimism on SoFi is that, first, the stock has no momentum. But when we look at their fundamentals, that's where things begin to break down. If we look at their financials, they have good revenue growth. That's very good. They are losing money, okay? And their free cash flow is negative. So you have a business that's losing money and you're burning cash. Okay, those are 2 pretty significant negatives, unless you have a story of, is SoFi gonna put banks out of business? Are they gonna disrupt other industries? And I don't know that that's going to be the case for SoFi. I think they do things in a way that the younger account holder appreciates. I'll give them that. But I don't know that they're doing something super transformational. Their balance sheets, I think they don't have, the cash is okay, and they should be carrying some debt, 5.3 billion in debt. So they have more debt than cash. On the cash flow side, operating cash flow is negative, and then they have to invest in the business. So they're burning a lot of cash. So I don't like SoFi, but I like Robinhood. I think Robinhood has been performing great. It's one of my holdings. I have a pretty good position in Robinhood, and you saw that SoFi was going down over the last year. Robinhood's been up 127%. I've been up on Robinhood. I've got multiple videos on Robinhood on my channel. You can look at them. And the analysis goes back on Robinhood, I think 2 or 3 years. So I've been big on Robinhood because I think they do have the ability to disrupt the brokerage business. They already did it. We can thank Robinhood for zero cost trades. They came into the market and said, hey, zero cost trades. And then everybody had to adapt. Now they're doing crypto. They're doing really well with crypto. And crypto is an asset class that's new, and some investors like it. Most investors don't. They're not trying to be the right brokerage and financial services company for all people. They're picking out the younger, newer, more technology savvy investor and kind of trying to dominate in that field. So I'm big on Robinhood. I think they've got the right mindset. They're trying to disrupt a part of the financial services industry. And I think they're going to be a pretty good merger or acquisition target for somebody because they're making a lot of noise and growing really well. So thanks for the question on SoFi. All right, so let me catch up on some comments. So Ian, Tesla's definitely priced optimistically. Their last earnings were bad. The upward swing is all hope and dreams. I'm a huge fan, and I have to be objective about my investments. Yeah, I'm right there with you. I think Tesla, if Elon Musk in the history books is going to be well respected. He came in and he created the EV market, along with some others. Some other companies were there too. And he really does deserve a lot of credit for disrupting and maybe getting EVs to be accepted by the general marketplace. So that was very interesting. But it's the car business. The car business has existed for more than 100 years. And when you have an old industry with a lot of strong players, it's going to be hard. The most valuable companies on the stock market, and I'll show you that list. The most valuable companies on the stock market: Microsoft, Apple, Nvidia, Google, Amazon, Meta. Okay. Their industries are 30 years old, 40 years old. These are newer industries, especially if you look at Nvidia, where they're really getting that big tailwind on artificial intelligence. Well, artificial intelligence is a concept you began to hear 10 years ago. So with these older industries, there's not a lot of room for them to grow because there's just so much competition. Going back to the competitive moats that I really focus on, you want a company that's in a newer industry. That newer industry is disrupting old industries. And this is a leading company like a Microsoft, like an Alphabet, like an Amazon. And those kinds of companies are where the money's at. So good comment there. All right. So moving along, I wanted to cover Nike. Nike had a terrible week. And the stock went down 20% in one day. Oh, man. And why did it go down so much? So first, I read through their earnings, and their revenue grew a tiny bit, but it wasn't like, oh my God, there's so much revenue being lost. So they grew a tiny bit, not much. I don't even think it registered as 1%. They made money and they generated a lot of cash, and they have a really strong balance sheet. They actually reduced their inventory, which is positive, and they increased their amount of cash on the balance sheet. So that's good. But the opportunity to grow, this is a big company. And if we look at their growth, it's been decent last couple of years. And overall, over the years, they have just a good growth rate. But this year, it's going to be flat. I think it's going to be less than 1%. It's going to be like point nothing, like 0.1 or 0.2 and percent. But the company, I think, is just dealing with, they did sell through and they've had some very good years. They need to let some demand build for their products, and then they'll return back to their glory days. Now, I am high on Nike. It's a stock that I didn't own 6 months ago. I started accumulating it let's say 2 months ago, and I'm going to be buying more shares. And the reason for it is the best companies, and I consider Nike being the best company in athletic footwear. And there's a big margin between Nike and whoever else, wants to compete against them, whether it be Adidas, Puma. I don't know who else is out there, but it really falls off after that. Nike is the best brand, and you can see they've really dropped since their height. They've gone down 57%. Well, I think that this stock is going to come back probably $120 a share, $130 a share. I don't know if it's going to happen before the end of this year, but I think over the next few years, it's going to return to that because it has the best brand. It's one of these companies. You could say that Nike belongs here. And the reason for it is you look at Nike and you look at their network effect, right? Meaning they have the best athletes under contract, where Nike is the company that partners with the most popular athletes. And these athletes are very influential in the markets that those athletes play in. And the supply chain and the scale that they have is immense, far more than these other companies. Some smaller companies are making some noise, like I believe Deckers, which has some shoes that are really, really desirable. They're making some noise, but Deckers is like 1/20th or 1/25th the size of Nike. So the Nike, I think, is an opportunity for me. I know that times are tough, but that's when you buy stocks, or I should say, these really premium stocks. You buy them when everybody hates them, when everybody's doubting them. But I see that Nike has this super positive brand. The brand itself is so powerful. Retailers will gladly put Nike on their shelves. Retailers will gladly put that inventory on their floors. E-tailers will gladly put Nike product on their websites. Athletes want to be sponsored by Nike. Nike is a very desirable company to do business with. So that's why I'm up on Nike when everybody else is down. And that's my reasoning. When we look at an example of my rationale is our friends at Meta. It's not too long ago that it seemed like the press was after Mark Zuckerberg, saying, man, this guy is the worst CEO ever. He's terrible. The metaverse crashed and burned. This company's terrible. And I thought, no, they're not. They're the number one social network company in the world. I forget how many billions of people have an active account with a Meta platform, whether it be Facebook, Instagram, WhatsApp. I think it's 2 or 3 billion people log into a system that Meta has. And now their AI business is going to take off. So buying Meta when everybody hated it is one of the best investments I've made in my lifetime. Because at the low point, which I didn't try to time, I buy and I average in my investment. From the low point, which happened in November of 22, to now, the stock's up 455% because this is the number one player in social applications. They generate high free cash. They are profitable. They were just misunderstood for a period of time. Is Nike similar? I think so. I think Nike right now, they kind of hit a wall when it comes to revenue growth. Understood. But I think overall, Nike is one of those premium companies. And I'm not going to be surprised if 2 years later, we're going to see a graph similar to this. Maybe not as awesome as Meta, but something similar. All right, so let me catch up. Shadow Guy, great to see you, man. Hope you're having a nice day in Switzerland. And I did get your email and I saw those pictures. I shared the pictures of your trip to Greece with my wife, and I thought they were amazing. She agreed, and we agreed that we have to put that on our list of things we got to do in our lifetime. So interesting stock on the decline, DDD. Let's take a look. Let me catch up on some other comments. Ian, I believe Nike has been given a premium because of its dividend and slow, steady growth. When investors fear that won't continue, it drops. This spells opportunity. Yeah, I think you're stating it kind of like the way I'm stating, which is, invest the way you feel you want to deploy your capital. And I share the way that I think, right? I'm not asking anybody to kind of say, hey, follow my instructions, follow my recipe exactly the way I do it. No, understand how I go about things. You could probably pick a thing or two that you think is interesting and maybe applicable for your style. My style is to really understand the business and either believe in it or not believe in it. Believe they're a leader or not a leader, and then kind of, play off of that understanding whether, in the case of Nike, I don't think anybody's going to argue with me that they're the number one sports apparel company, footwear company in the world. Nobody's going to argue. So the only thing about it is, okay, well, is Nike going to be bigger, stronger, better in 5 years? I think most people would agree. Yeah, I think so. Okay, then I'm an investor because the fundamentals tell me the stock's discounted. I'll show you the fundamentals on Nike and it'll show that the company's discounted. So I appreciate you being on, Ian. And then my man, Scott, how are you, sir? It is good to have you on my live stream. I appreciate you joining. I hope you're having a really nice weekend. All right. Chi Wong, thanks for answering the questions. Yeah. Hey, keep coming back, man, and keep asking questions. I really appreciate it. And around what SP stock price are you buying Nike? So I bought shares on Friday. It dropped 20%. I bought $1,000 of shares, and I will buy shares of Nike each week. I try to pick, a good point, but I try not to be perfect. Right now I have, how much Nike do I own? So I own $10,000 in Nike. I could see myself buying $50,000 overall of stock in Nike. I could see me owning $100,000 of stock in Nike. And it's that business that I want to be a part owner in. The Nike business, there's only one on earth. Once you get to the number 2 player after Nike, it's a big giant drop. It's like Apple for the iPhone. Okay, that's the biggest, the most desirable ecosystem in iPhones or smartphones. And then after that, it drops off. Not even as far as like what Nike has. Once you drop off of Nike, you're like Adidas way down here and other brands are way down. So I want to be an owner in Nike. Thanks for the comment. Appreciate you joining. All right. So the Family Guy, I think you've been on before and I appreciate you being on. What do you think about Kohl's stock? Upcoming earnings call in August. And you know what? I forgot to do DDD. So I'm going to come back to that. And then I'm going to do Kohl's. And I think I'm caught up on comments. Keep them coming. I appreciate everybody being on. Let's do DDD. So this is 3D Systems. I have heard of this company over the years. I've never been an investor. And this company, 3D Systems Corporation, provides 3D printing. Remember when that was like super hot, like 10, 15 years ago, maybe 20? It was like, oh yeah, we're going to 3D print everything. And I think some guy 3D printed a gun, if you remember that. And then he was able to fire it. That became really interesting in the wrong ways, but you could really see that, hey, that might be something, but it never really took off as much as, it was being glorified to be. So that was interesting. So 3D Systems, 3D printing, digital manufacturing. Got it. Okay. So they are put in the category of computer hardware. That makes sense. And they have 2,000 employees. So I know their business, their market cap is pretty low, 400 million. And they're actually being priced as a market cap. Market cap is higher than revenue, which is interesting. They don't pay a dividend. Analysts are saying that it's the price target is much higher, 132%. I had to read it carefully because I'm like, am I reading this wrong? Analysts are saying it's heavily discounted. Interesting. Over the last year, it's been on a downward slope, down 68%. Holy smokes. So they've been losing revenue. Looks like their high point was in 2018. And since then, they've lost revenue in 2019, 2020. They had a good year in 2021, and then they had a bad year in 2022. Balance sheet looks so cash is 568, looks okay. Debt, current debt's just 9 million, and long-term debt. Okay, so they have about as much cash as they do debt. Do they cash flow? Let's see. Operating cash flow is negative, and then and this is giving me old data, so I don't think I have perfect data on this one, but I'll be able to give you an opinion on this. So their forecast, let's see if the forecast is reasonable here. Oof, revenue forecasts, they're going to lose money. So I would not be investing in 3D systems. And here's the reason for it is, if I knew, which I don't, if I knew that, hey, there's going to be this event that's going to make 3D systems super valuable. Like there's going to be 3D printing. I'm just making this up, total hypothetically. But in order to make AI happen, you have to 3D print these special circuit boards or connections for the data center. And all of a sudden, 3D systems revenue is going to double, for the next couple of years. Now, if I knew something like that, I'd be a total buyer into 3D systems. But what the market and really reality is telling me is 3D technology did not take off like it was potentially going to do. It just didn't. It hasn't taken off. The revenues tell me that that market did not become a big thing. It just was a fad where it was interesting. There's probably a couple interesting applicable use cases, but it didn't become a massive thing. And investing in small companies, investing in long shot turnaround stories has probably been the area that I've lost the most money in the last 5 years. So I don't like losing money. And I think that I would be putting myself at a lot of risk in buying 3D systems. So I am not a buyer of 3D systems. I hope you found that interesting, Shadow Guy, and happy to take any more questions. So I covered 3DDD. Now let's talk about Kohl's. All right. So Kohl's, how are they doing? For 1 year, flat. Okay. They pay, wow, their dividend's really high, 8.7%. Why is their dividend so high? This is a retailer. Okay, let's take a closer look. So revenue has been declining. Not a big surprise. This is retail. Man, and I'm going to have some comments at the tail end of this, but let me just kind of get into fundamentals, and then I'll give you some comments on how I feel about retail. So revenue's been coming down. They are profitable for 2023. And looking at their quarterly shows declining sales, loss in the last reported quarter, but really profitable in the quarter that included the Christmas holiday. All right, that's good. Cash flow wise, the company, and this is, let me look at annual and then I'll look at trailing 12 months. So cash flow looks good. Their operating cash flow is 1.3 billion. And I don't think they have too much CapEx. So 754 in free cash flow, that's pretty decent. And 754, yeah, I mean, you could probably make Kohl's, you could probably show that it's discounted based on the cash flows they're going to produce. But I'm just not an investor in retail. It is so damn tough. Retail has to, you got to rent, commercial properties that cost a lot of money to air condition. You have to buy a bunch of inventory that is very perishable, right? You have garments that are in the spring and then nobody wants them again. Like literally the next year you can't sell them because people are like, oh yeah, that's the fashion that was in last year. We don't like that anymore. Some things are exceptions like underwear or socks and stuff. That's always in, or Levi's. But just the retail business, right? We get, as an investor, there's no rule of us. You can only invest in this set. You can only invest in retail companies. No, you can invest in technology companies, healthcare, if you find that, hey, I really like this pharmaceutical company, they provide drugs that help these particular diseases with the right treatment, they make lots of margin, they have few competitors because they have the right patents. Those are the industries I want to put my capital to work in, not retail. Retail, if you look at retail, back to my graph here, I put the least desirable companies like Macy's in the weakest competitive moat in the marketplace. Because when you look at Kohl's, they're competing against Macy's, retailers, one-off shops down the street, e-commerce, Costco, Walmart. I mean, it's like, holy smokes, you're competing against the world when you operate retail. And that's why I'm like, okay, a very undesirable business that where will Kohl's be in 5 years? I would, I hate talking bad about companies, but I'm just going to say it. I wouldn't be surprised if they'd be bankrupt. I wouldn't be surprised if they follow like Macy's, which has been just declining because retail is so darn tough. So I think the fundamentals of Kohl's look good. That dividend looked really high, but I want to make money for the next 25 years. And I'm probably going to make more money betting on the strongest companies. And I'm probably going to make more money staying out of the weakest industries. One of the weakest industries that I see out there is retail. So I'm staying out of retail. Thank you for the question. I hope you found my comments interesting. And I'm happy to listen to any type of critique. If you see it otherwise, please comment. I am learning from viewers all the time. And I appreciate when somebody takes an opposite view on a company or a situation. Sometimes I end up learning something and realizing that I was wrong. But I'm going to state my view, and hopefully you find it interesting and it's constructive just to hear one more person view, kind of communicate their view of a particular sector. All right, Omar, good to see you, man. I think I would invest in Nike at least $1,000 and play it safe. Well, good luck with that. I've never provided financial advice to begin with, but I appreciate the comment. Scott, okay, did a video on DDD in 2021 and had them as a sell. Stock is down. Yeah, man. It's good in 2021, which was 3 years ago. I think you saw the writing on the wall, which was, this industry is just not going to take off. But it's really cool that you had a video back then. It really shows credibility to your channel. And Kathy Woods owns a lot of DDD. Kathy Woods, I heard a pretty interesting comment, which I already knew before, but I watched The Compound. And if you guys watch that on YouTube, it's Josh Brown. He's a well-known guy. He comes out on CNBC. And I didn't like Josh Brown like a year ago, but I started watching his channel and man, I really like it. I think he provides his point of view and it's clear. He doesn't, hold anything back. And I appreciate that. I don't invest like him on all cases, and I do in some cases, but he came out with this comment. He had an episode where we had the professor Siegel. He teaches at the Wharton Business School, which is University of Pennsylvania, really famous author. And he comes out on CNBC and they talked about how there's some super investors like Kathy Woods. She had a great 2020. She nailed Tesla. She nailed a couple of things and she had a great year. Well, she's trying to ride that and say, oh man, I'm an awesome investor because I had that one good year. But using a sports analogy, right? I'm going to use, let's say football, right? American football. And Tom Brady undeniably is the greatest quarterback in the history of the NFL. Undeniably. Maybe the greatest football player in the history in the NFL. The most championships, just consistent performance and so forth. And then there's probably 100 players that played the quarterback position in the NFL that had one good year and nobody knows anything about those guys. And that's the difference in stocks is you have Michael Burry, got nothing against Michael Burry. Awesome movie on The Big Short. He nailed the subprime market. He shorted it and he came out looking like a genius. And I would love to hear an updated comment on this, but I am not aware of anything else that Michael Burry has been absolutely correct on. Big thing, like something else of significance. So I give him full credit that he nailed the subprime mortgage meltdown, nailed it. After that, I don't see anything. So it was interesting comment that I saw in the compound, and Kathy Woods was one of the topics they talked about. Anyway, moving on. Family Guy. And I love that handle, by the way, the Family Guy. I'm a family guy. Yes, I'm doing some put options. Cool. Good luck with that. Give us the details on some comments. Learn with me. Good to have you. I'm not sure if you've commented before, but it's great to see you. Please cover SHW GILD, which is that Gilead, and then Nike. I covered Nike. I probably covered it, at length, so you can watch this live stream again. I'm not going to cover Nike again because everybody else already heard it, but I'm going to cover the other two stocks. I appreciate the comment. Let me catch up on comments, and I'm going to come back to these stocks. Family Guy, appreciate you, man. Mr. 123 Cheetah. Hi, Victor. What's your view on VEEW? Let me take a look at it, and then I'll tell you. I'm not familiar with that stock symbol, so let's take a look. All right, so I'm going to start with SHW. Sherwin-Williams. Okay, these guys do paints, and predominantly paints where people are painting their houses, remodeling. Okay, coats and paintings. All right, for both commercial as well as retail. So people could go in and buy paint and paint a room, paint their house on their own. But I'm sure a lot of painting contractors are buying their supplies from Sherwin-Williams. Looking at their stock, for the past year, it's performed well, 16.87%, has a small dividend of, let's call it 1%. Market cap's really good at 75 million. I mean, really respected company. This is a brand that I'm familiar with, and it's what is they're a specialty chemicals. Yeah, I guess paint is a chemical. They're a material space. I like material companies. Okay, so their forward P is 25. Their current P is 31.78, which is a little bit high. Analysts cover it. They're saying that it's discounted by 13%. They're saying that it's a buy. Okay. So let's take a look at their financials. They've had growth, really nice growth. Man, look at these years. I guess they acquired companies back then, but their growth has been really good. Looking at the quarterly, growth is slowing down. The last finished quarter, their revenues, their overall revenue declined by 1.38%. All right. Nothing to be overly concerned about as long as they can just get back to growing. Okay, so their revenue looks good. Balance sheet, cash is there. Their current debt is $3 billion, long-term debt. So this is 12.6 billion. Okay, what's their net cash to EBITDA? So their debt to EBITDA, excuse me. So debt to EBITDA is 2.74. Okay, that's good. I want it to be less than 3. I don't want too much debt. If you have too much debt, it could be a really good business. It could be like, oh, wow, they just have great products, but debt will kill a company. Debt will limit a company. So in this case here, they don't have too much debt. It looks okay. And then their free cash flow. So trailing 12 months free cash flow is $2.4 billion. So just kind of back of the napkin. It's not going to, so 2.4, right? I multiply that times 20 and I get 48. 48 billion would be my first guess as the valuation of this company using cash flow. And their market cap's too high. I'd probably see this company being overpriced by a pretty good amount. And it is kind of a Dow-based company, so I don't expect they're going to go up a whole lot. They're at a pretty good point. I mean, they're doing fairly well. They were much lower even before COVID, they were way down here and now they're up here. So this company here to me looks like it's not a great investment. I'm not overly excited about it. I think I saw that $2.4 billion of free cash. I multiply that times 20, and that's for a growing company. These guys they were growing, but they kind of hit a wall there. I wouldn't invest more of my time in looking at this stock because I wouldn't be interested. So good luck with this company. I liked a lot of things about it, but once I look at the fundamentals, I'm like, yeah, it's being priced too high. The company's priced too high. All right. Next one is GILD. So GILD. Gilead. All right. I like biotech pharma. This is a biopharmaceutical company. All right. I know what they are. So these guys, what I like about them, back to this quadrant here, why is Lilly so damn valuable? Is because they have patents. And if they have a patent where a lot of people suffer from a particular disease and they have the cure, they get to charge a reasonable amount and recapture all of their investments to make that drug. And that's the business that Gilead is in. If they have the right patents, this business could be very valuable. They have a lot of volatility. Holy smokes, what the heck's going on? So not too long ago, they were trading upwards of $90 a share. Now they're down to 68. So they have a high dividend. Interesting. Analysts think it's discounted by 20%. Interesting. Market cap, 85 billion. Okay. So the revenue has been flat. That's interesting. They were growing nicely and then they stopped growing. So maybe that's what investors are freaking out about. It's like, hey, where's the growth? They are profitable. Looking at their last full year, they grew their profits really nicely. Cash flow is trailing 12 months, 7.9 billion. Okay. And 7.9 billion. This is an interesting company. Now I'm already invested in Pfizer and I have a couple others like United Therapeutics is probably my favorite little, biotech company. And I have Catalyst Pharmaceutical as well. So I'm not looking for any more. If anything, I'm looking to sell one of those three and vote one of them off the island. This is an interesting company. I think to the investor that believes in Gilead and believes, hey, they're going to grow. This is what's going to happen over the next 5 years. And you think that it's going to, let's say the company's going to grow at a really good rate or a really good consistent rate. This could be a real nice winner. But you'd have to put the homework into it. It has enough there where if I didn't own those three other companies that I just talked about, I'd probably put a little more time into Gilead and see if, hey, this company is having a bad year. People hate it right now, but in a year or two, people are going to realize this is a really valuable company. Okay. So good luck with Gilead. Hope you found that interesting. Let's talk about BEE. So Viva Systems. So Viva Systems provides cloud-based software for the life science industry. It offers Viva Commercial Cloud, a suite of software analytics solutions such as Viva Customer Relationship Management that enable customer-facing employees at pharmaceutical and biotechnology companies. Okay, never heard of them. 29 billion. Okay, pretty good market cap there. PE is not bad if they're a growing company. They have shown really good growth. Interesting. Revenue looks good. Trailing 12 months. Looking at the quarterly. Man, they're growing really well. That looks really good. Balance sheet. Make sure they don't have too much debt. They don't have much debt. They have 55 billion in debt and they have 3.5 billion in short-term. Combined with cash, they have like $4.7 billion and they have 55 million in debt. It's looking great. It's looking really good. And then they have free cash flow. Man, this looks good. What's going on? So they have $1 billion. Okay. So they're fairly priced. They could go up. Now, here's something that I've seen. Now, I own a couple of software companies already. Um, this one looks pretty darn interesting, man. Why have I not looked at this company before? I'm going to put this one on I want to look at it closely. I think I'm seeing a lot of quality. And I'll tell you another thing that I'm seeing in the market. So, the market, sometimes referred to as Mr. Market, it has, and that's not where I wanted to go, by industry. Software companies have been left behind. Semiconductor is really taking a lot of the gains, but software companies are really valuable. Software companies, they write like an application. Think of like TurboTax, if anybody uses that. They just have to write one piece of code. It's a pretty significant piece of code to do all of that stuff that you have to do taxes. But then Intuit sells it to 300 million people, 200 million. I don't know how many people they have, but my point being is they don't have to like back to Tesla. When Tesla sells a car, they have to manufacture parts, assemble a car, sell it to a customer, deliver it to a customer. Supply chains are really complex. Where software, no. Once you develop that code, you get to sell it to as many customers that want to buy it, and your margins are just really, really good. Your cash flows are great. No big surprise, Microsoft's worth $3 trillion. Is there a software company? So software companies are really valuable. So that company is in a category that's a desirable company. But I've observed that small software companies are being left behind. That's not going to be a permanent thing. It's not going to be like they're going to be left behind forever. And I am buying into good quality companies. Like Adobe's been one of my winners lately. Adobe was discounted and I snatched up shares and made a nice quick gain. So I just did a video on it. You can watch it. I put out there how much money I made and so forth. But this guy here, so software applications year to date, remember how we were looking at the S&P is up 15%, the NASDAQ's up 20%. Well, judging from those metrics, software is being left behind. It's semiconductors that are taking all the attention. And even hardware companies, which is completely wrong, by the way. Hardware companies are not that valuable. But if you look at historical, like if we were to look at software applications, this is the market cap. This is not giving me what I want, but I was hoping to get the historic returns, and you would see that software companies are just really valuable. So that's another reason that I'd be interested, but I'd also want to wait until the momentum changes a little bit because I hate parking money into a company and it just sits there and it doesn't go anywhere. But Vive was a really nice company that you brought up. I appreciate it. And I'm going to do some more homework on it. So that's my comment, is that it's interesting. It's interesting enough to do more analysis on it. I'm not a buyer just yet. I'm just going to keep looking at it. Thank you for the question. All right. So Neil, that's okay. It looks like you were keeping up with my analysis. I appreciate that. So AI Scribe, I really liked your video on NVIDIA. I looked at AMD totally due to traction around MI300X. Appreciate the content. Hey, I appreciate that comment. I am a fan of NVIDIA, and I don't think I've talked about NVIDIA just yet, but I just recorded an update on my short position on NVIDIA. And basically, I'm down a little over 4% on NVIDIA on my short position. And I started shorting it at the end of May. And the whole reason for my short position on NVIDIA is that, one, I think the company is great, but their stock has gone parabolic. And those situations, and I covered that on my first video, which came out in May. And the video I just recorded and will be released mid this week is not going to go to those depths. But we've never seen a stock go parabolic the way this is showing. And it ends with the company. Then the company continued to go up in value, or continued to moderately go up in value. it's always a situation where it ends where the company dropped in value and it took a decade or two for it to get anywhere near the previous stock price. I did my homework on it. I believe that's what's going to happen in NVIDIA. More people are beginning to say that in the month of June. Even Mr. Jim Cramer, who is probably the biggest cheerleader of the AI hype, is saying people should take profits on NVIDIA. Guys like Josh Brown are clear in saying that it's ridiculous the way it's priced. He owned NVIDIA for a long time, sold his position 6 months ago, sold part of his position. And he's like, I'm like him or he's like me. I think NVIDIA is great, really intelligent company, but the company is not the stock price and the stock price is not the company. They're two different things. The stock market has gone crazy over AI and they've gone crazy over NVIDIA. NVIDIA is going to do what NVIDIA is going to do as a company and they're going to be successful. No doubt about it. But the stock price is what I'm focused on. And I think the stock price is going to come down. So check out my video on NVIDIA. It'll be out midweek and would appreciate the comments. NVIDIA, that, I shorted NVIDIA stock, got the most comments of any of my videos. And I appreciate all of them. I appreciate especially all the people who are like, understand my point of view and respect it and have I think a constructive comment. The ones that are kind of a little bit, I probably ignore more are the ones that are just kind of like critical with no content. It's like, whatever. We'll see who's right. I might be wrong and I will eat a big plate of crow and I will do a video that says, this is how I was wrong. And I lost this amount of money. And if it goes the way that I think it's going to go, I'll make a video that says, hey, I guess it worked out the way that I thought it was going to work out. And this is how much money I made. It's called investing, nothing personal. I'm not saying nothing negative about NVIDIA. I just think their stock price is too high. So thanks for that comment. I really appreciate it. And would love to see you back on live streams. And I'd love to see your comments on other videos. All right. So, hey, thanks for attending. Thanks for bringing up Vive. I'm going to take a closer look. And I've gotten some good video ideas, investing ideas from these. So Brian, hey, thank you, Brian. I appreciate that comment. It means a lot. Like Scott's on this live stream. If he's still on this live stream, it does take energy and takes some time to do these videos. I learned a ton off YouTube. So my whole inspiration of doing my channel is because I'm learning from the, community of investors around the world. And I wanted to do my, kind of my part. And I do find it really interesting and enjoyable, but, life does get really busy for me. And it really fuels me when I get a positive comment from viewers that show their, their appreciation. I really appreciate it. So let's talk about Comcast. All right. We're going to talk about Comcast. And I'm going to catch up on some comments. So give me a second. And Airbnb, man, now you're speaking my language. I love Airbnb. I love staying in Airbnbs and I love being an Airbnb customer. And I love being an investor. So although the company and the stock are two different things, don't you think that eventually over time, the stock price will reflect the company? Absolutely. It will always end up being closer. For example, Microsoft, the great Microsoft, at one point in the late 90s, Bill Gates, the co-founder of Microsoft, said, our stock price is too high. It's gotten run up. He said it. And the stock price kept going up. And then after the dot-com bubble, it took Microsoft over 10 years, probably closer to 15, 20, for them to get back to the same price that they were at during the dot-com bubble. Microsoft continued to go up from that point, and Microsoft is worth $3 trillion. They are a great company. They have businesses they have competitive moats that are as good as anybody's. They continue to drive new ideas and new revenues, like their cloud business, their AI business. It's just a great company. And I think their stock price and the company, I think, are aligned. It just, for a while, it was misaligned. And the CEO of all people was the first one to say it. Our stock price is misaligned with the company. It's too high. We're down here. People are crazy about the stock. We appreciate it, but let's get real, people, is what he was saying in the late 90s. So I appreciate it. Very good thought. Bidol. NKA, Nike, Vic. So I guess so the symbol is NKA. Glad to look at it. I'll take a look at that. Oh, did you mean Nike? I covered Nike. And I covered Nike earlier in the live stream. And I'll also tell you, I just recorded an update on Nike. It's needs to be edited, and it'll come out late this week. So watch the live stream again. You'll get my comments on Nike. And then if you want the full video, end of this week. I appreciate it. Thanks for tuning in. You found me through Scott. Man, Scott's awesome. I've learned a ton from him, and call him my friend because I, have a good communication with him, and I continue to get value from him. I watch his videos consistently. Shadow Guy. So you used Airbnb on your trip to Greece. Awesome. Yeah, I'll cover Airbnb in a minute and have a lot of good comments there. Heck yeah, I can't wait. Cool. All right, cool. Thanks, Vidal, and thanks for tuning in. Appreciate it. Oprah. So Oprah. Okay, cool. So we got some stocks to take a look at. Yeah, so take a look at the Microsoft story. But some companies like Cisco, it never got back to the stock peak. Amazing that it never did, but that's the case. All right, so let's take a look at these stocks, starting with Comcast. So Comcast is a business. It's kind of some businesses are able to keep up with the times and continue to be relevant and viable, and Comcast is one of them. Comcast, if you look at their history, the company was founded over 100 years ago. They were like one of the original studios, okay? Like they had a studio in the silent pictures era and so forth. And they have a movie business where Oppenheimer is one of their titles, as an example. But they diversified. They have a theme park business, Universal Studios. They have a broadband business, which I'm glad they have a broadband business. And the way they've managed their business, I really like that. If you look at other communications companies like AT&T, Verizon, they load it up with debt, and then they make themselves really undesirable to me because their balance sheets are terrible. Comcast has a strong balance sheet, and they have a diversified business and businesses that are doing well. So I like the business. They pay 3%. And coming back to my spreadsheet, right? Now, would I put Comcast in the most desirable bucket of companies? No, I put them probably in kind of like the upper end of one of the medium desirability companies. They're not as strong as, like a Microsoft and so forth, but they're pretty darn competitive. You look at their Universal Studios, their movies, they do have a moat around their best movies. Those movies like Oppenheimer are very valuable. They made money selling tickets to watch the movie, but they also get to now sell the movie rights for like Netflix to pay them to show that movie. So overall, the moat is, I would say, medium desirable. It's a defined moat. It keeps most competitors out, but they do have competitors like Disney. Disney's probably their most closest competitor. And overall, analysts believe that it's discounted by 24%. I agree with them. Their financials, they're a slow-growing company. They're of good size, and they have a strong balance sheet. So their balance sheet, they have good cash amount. Their current debt's $2.5 billion, and then $94 billion of long-term debt. But when you look at debt to EBITDA, it's under 3. So that's important to me. Cash flow, they cash flow nicely. Free cash flow. $13.5 billion. $13.5 billion per year of free cash flow. So when we look at that, 13.5 times 20, I get 270. This isn't growing that much, so maybe 270 is the wrong ratio. Just back of the napkin, 153 billion compared to that. Now I have a valuation on Comcast. So let's take a look at that. And here it is. So I think it's discounted by 31%. I think their cash flows are really strong. And I think their earnings per share is really strong. So Comcast is a quality company in my eyes. And a 31% discount is worth me investing in the company. I've bought Comcast, made good money, got out of the position, and then saw it drop. And I was like, oh, I'll gladly buy the shares again. So I kind of bought around this zone. It went up and it came back down. Okay, great. I'll load up and I bet you it's going to go up again. So I'm buying into Comcast and really like the company. Airbnb is one of those companies that I would put up in this zone up here of high desirable competitive moat against their competition. Why would I put them there? So Airbnb, they do short-term vacation rentals. And their difference is they only work with property owners that want to go direct on their platform with people that want to rent them out when they're on vacation or maybe extended stays. And they were the first one to really they were one of the first companies to do it, and they had the best experience. And their experience was so much more desirable that they ended up running a lot of the existing players out of the market. And the existing players are just not growing the way Airbnb is growing. So the vacation rental market, if you think about the addressable market, the total market that they can go after, it's massive because like in the US, it's big. And we're talking about now people could travel to small cities, mountain areas, outdoor areas, Hawaii, Florida, you name it. And Airbnb is everywhere. But globally, they're growing really fast. Latin America has become really a place, a destination where a lot of Americans and people from Europe like to go to. Even people from Asia go into Latin America. Going to Asia, you can rent on Airbnb. Going to Europe, like one of the viewers just said, he rented on Airbnb. So I believe that the business is really valuable, and Airbnb is the number one player in that market. So it's an expanding market. It's a massive total addressable market potential, and this could be the Netflix of private rentals. My background in this field, I bought 2 properties and put them on Airbnb in 2012. So that's 12 years ago. Rented them out for 10 years, did really well, sold those properties, made money on the properties, but every year we made good money on Airbnb. So I was an owner, so I had that experience. I've rented on Airbnb for 15 years. So I've been a customer for that duration, and I've been a stockholder for the IPO'd, I think, 3 or 4 years ago. And I didn't buy when they IPO'd, but I bought after the stock came down. I think I started buying in 2022, and I'm sitting on a nice gain. But I think it's got a lot of upside because this is a company that's at $97 billion in market cap. And FYI, they have a higher market cap than hotel companies that have been around for 100 years. They're going to keep getting bigger and bigger. They're going to be the Amazon of this like hospitality business, because hotels, it's very capital intensive. Hey, I want to build a new hotel. Okay, it's 500 million. Come up with 500 million. It takes 3 to 5 years to build. Finally, you got more rooms in a city. Airbnb can grow organically fast because they're just working with the direct property owner of a house, of maybe a second unit that they have. Maybe an apartment building owner wants to convert it into Airbnbs. I mean, it is just growing organically, and it's been really interesting to watch. They're a positive growing company, so I like that. Their growth is slowing down. Their stock price is taking a hit because Airbnb told the market, hey, our Q2 isn't going to be great, but our Q3 is going to be awesome because the Olympics are being held in France And a lot of people are booking on Airbnb to go see the Olympics. So Q2 is a good opportunity to buy more shares. Q3, the stock's supposed to really run. So overall, I have a video on Airbnb. I have a valuation on Airbnb. I think the stock is discounted. And let's take a look at that really quick. So here's Airbnb. The current stock price is 151, I think 50. I think it's discounted by 45%. This is the company, this is the premium brand in their industry, their micro industry. And I just think the market's going to keep expanding for them. And this company is going to be like Netflix. It's going to be like Amazon. At some point, they're going to be worth a lot more than $100 billion. So thanks for the question on Airbnb. And I think the next one was supposed to be Nike, which I commented on. And I think the last one we're going to cover is OPRA, which is a symbol I'm not familiar with. Opera Limited. So Opera Limited. Opera Limited, together with its subsidiaries, provides mobile and PC web browsers and related products and services in Norway and internationally. The company offers mobile browser products such as Opera Mini. Okay, so they're like a browser, similar like Google Chrome. Okay, interesting. I'm not familiar with them. It's 1.2 billion, pretty reasonable market cap, $400 million in revenue. Analysts say it's really discounted, and there's a strong buy on it. Okay, dividend of 5.7. Wow, interesting. Company's been growing. All right. Looks good. Continues to grow quarterly. Man, good stuff. Looks good so far. They have free cash flow for the year is $23 million of free cash flow. Not a lot, but I think the growth is what's making the company very valuable. They have $99 million of cash, and they have, let's see how much debt, 6 million long-term, 7 million. And so they have about 10 million in debt. Very good. They don't have a lot of debt. So this is an interesting company. I don't know a lot about their product, but I think their valuation is being based on earnings per share and growth. It's not on free cash, because free cash will never get you to this value. And this is another company I'm going to write down and take a closer look at. I think it looks really interesting. So they're headquartered in Norway. They were founded in 96. Okay. And let's take a look at their website. Your personal browser. So their claim is that it's your personal browser and you get to set the security settings. Interesting. Okay. Hey, this looks interesting. Yeah. I'm going to take a closer look at that. I think it's worth looking at. Yeah. Thanks for the suggestions. I like what I saw from revenue growth. I really like their revenue growth. This particular market space is one where they have a lot of addressable market, because I think a lot of people are concerned and really would value having better privacy on a browser. That makes sense. And analysts are agreeing that, hey, this is an up-and-coming company that has a lot of value. Analysts are saying 47% discount, 40 big price discount. They're profitable. Yeah, there's a lot to like here. So I'm going to take a closer look at it, and I think it's worth analyzing. I'm not at a point where I could say, oh, I'll be buying shares. I have to do a lot more homework on it, but I appreciate you bringing it up. That was a good one. All right, so that was an awesome live stream. I really appreciate everybody joining. This coming week is going to be one more interesting week. It's great that we've had 6 months and we've had an up market. I hope everybody's making money. I've made a good amount, which is great. Now it's like, hey, how can we make 2024, a positive year? looking at my shorts, I think that's the area that has become really interesting for me, specifically around semiconductor. I'm shorting NVIDIA. I shorted Supermicro, and I'm shorting a couple of other companies. And the last company I'll put out there, I meant to say this. I don't know if Scott's still on, but I watched Scott's channel, and one of the companies that he covered was Vertev. And Vertev is a company that I shorted, and I'm doing well with it. And it's because Vertev is it's a company that does cooling systems for data centers, and their stock just took off. And if you understand data centers, this stock price is completely detached from this business. This business, they sell literally like plumbing. If you thought about plumbing in a house, they sell the plumbing that'll cool data center racks. Well, there's not a lot of like intellectual property in that. It's just good quality cooling equipment. But they're being traded like a semiconductor company. So there's something wrong with that. It's like, wait, they create cabinets out of metal. Anybody could do that. And they create these products that don't have a lot of, design, IP, engineering in them. And their valuation just gone crazy because they're associated to the data center. And so far, so good. I'm favorable 6% on that short position. And that's the kind of stuff that I'm finding in the AI hype. Is you look through them and you go, hey, some of these companies, I don't understand why they're so valuable. Like Supermicro Computer is another one I've shorted. They're a hardware company. Well, hardware companies do not carry high valuations. And that's made the market really interesting for me in semiconductor, because I'm not buying into semiconductor companies. I had Broadcom. I made good money on it. I sold it. Qualcomm had made good money, sold it, because I just think that space is way overpriced. So anyway, so that's my live stream for the week. Everybody, thanks for tuning in. And I really appreciate everybody's support. Everybody have a great week.